Good afternoon, everyone. I trust we're all doing well. Welcome to the YLP KSS session for the month of November. YLP is called the Young Legal Professionals. We have Theophilus, our facilitator, is in this session. Spare me while I ask him. Theophilus, please, can you unmute yourself? Theophilus, can you hear me? Could you unmute yourself? I've sent you the request. Yes, thank you.
Fine. That's fine now. Thank you.
Okay, thank you very much. So yes, please, thank you once again for being here at our request. Good afternoon again, once everyone. Thank you for attending, registering, and participating in the YLP Knowledge Journey session for the month of November. The topic for today is the ABCs of financial reporting, a lawyer's guide to understanding financial statements. We have with us Theophilus Ukpega, who is a compliance officer at the Premium Trust Bank, who is going to take this session for us today. So in order to drive home the lessons we'll be learning in today, we will also be examining the 2022 to 2024 annual reports of Dangote Cement and MRS Oil and Gas Limited. MRS Oil and Gas PLC, which are all publicly available data for every one of us to verify. The essence of today is to ensure that the lessons we learn today, you are more than confident to see an annual report and then be able to interpret the financial data that you see there to be able to make an informed decision, not just for yourself, but also for your clients. So I yield the floor to Mr. Theophilus to please lead us. Thank you.
All right. Thank you, Barrister Hussein, for inviting me here. And without wasting time, we'll quickly go into the session. I will try to share my slide from here to guide us and to ensure that we're on the same page. Please, you need to enable me to be able to share my slide.
Sorry, so I'll make you an host in order to be able to do that. Thank you.
All right, thank you.
You're welcome. You have the floor now. So you should be able to share your slides. Thank you.
I'm trying to do that. Please confirm if you can see my slide. Please confirm that you can see my slide.
Okay, no, we can't see it yet. So I need to, so once I make you an host, the setting is set to the effect that every other person is muted and their video is off in order not to distract the session. So once I give you host, if you need me to speak back, once I mute myself, you need to ask me to unmute. So I'm going to give you the host back, so you should be able to do that from your hand. Or better, so you could try it now. I've done the general setting to allow participants to share their screen. So you should be able to share a screen.
Can we see the screen right now? I think I'm transmitting it from here.
Yes, yes, it's transmitting now.
Thank you once again, and the session will last for an hour and 50 minutes. Ordinarily, it should start 2 o'clock and end 4:30. We have another commitment by 4. So I would just want to end 10 minutes to 4 to prepare for the next commitment. Please pardon me, but I will ensure that we get the best of the time that we are spending together. So, as rightly seen on ABCs of financial reporting, a lawyer's guide to understanding financial statements. So, I'll see, and I will not want to spend more time on telling you about myself. Let's focus on why we are here. So, the objective of this section, so we hope that at the end of this session, we will be able to appreciate financial statement information. We'll be able to spot some possible red flags. We'll be able to understand different depreciation methods. We'll be able to understand window dressing using depreciation and other financial data. And we'll be able to calculate financial ratio to be able to advise clients to make informed decision. It can be helpful for us too, especially if we plan to invest. Financial ratio can help us to take decision, to guide people, and to help ourselves. I'll go to the next slide, which is about financial statement and its components. Financial statement is like an handbook. This handbook tells a story of how an organization has performed in a specific year. It's like a storybook that speaks to what, let me liken it to a biography. However, biography is for a lifetime. A financial statement is talking about a financial year. So that similarity may not be entirely, but see it from that perspective. So an organization has been existing for a while and is reporting its financial for a particular year. For each person that owns the handbook, you should be able to read it and say, this company is healthy, this company is struggling, this is a good company to invest. If this company can work on this, it can do better. This company is struggling in this area, but they are doing well in this area. You can be able to put those figures together. I mean, the financial. The financial statement, however, like I said, is a storybook, it's an handbook. It comprises of both financial and non-financial. Example of non-financial is CRS, an organization that is into corporate social responsibility may also put that information in the financials, stating how much they have added back to the society within which they operate. Another area is their compliance level to SDG goals when it comes to equity, ensuring that these popular climate issues are compliant with, especially for companies in oil and gas sector, where gas are usually flared and they can have a whole lot of pollution both on the water and on the land. So they want to, like I said earlier, see it as a storybook telling us, and when I say us, it's speaking to employee. So those are the users of financial information. The employee of that organization, they need to know how healthy the organization is so that they can know if to quit, join another organization, or to stay. You want to know how healthy your employer is. So some people invest all around, invest here and there. But for you to be able to form a decision, is this company good enough for my hard-earned cash to be placed on them? How well is the organization managed? You want to know that before you commit your fund into that business. Some other people are researchers. Some other people are government for the purpose of tax. So for researchers, they can pick random financials of organizations in similar industry. For Nigeria, you can pick Oando in oil and gas, you can pick Total, you can pick Shell, you can pick Dangote and the rest of it. Because for you to be able to do proper comparison, you should compare the likes with likes. You cannot pick a financial in the banking sector. You cannot pick a financial in banking sector and be comparing or benchmarking that financials with another in oil and gas. You will not do justice justice to that. If you pick a financial of a bank or a financial
Sir,
institution, it is
sorry,
okay.
apologies to you. Please, could you, the slide is no longer showing on the screen.
Oh, really?
Yes.
Sorry about that. That
Um,
must be. Let me try to transmit it again. I think when you took over the control, it stopped sharing. Maybe that's what happened. But 1 minute, I will try to. So right now, are we good?
okay.
Are we fine right now?
Yes. Please, could you try clicking on the, no, minimize it. Click on the present icon, the icon beside, go down below. On that same line, just go down. The icon that
Okay.
is like a projector. No, on the sharing page, the presenting page of the slide.
Okay. A minute, please.
No problem.
Okay. I have more. I have more here.
Okay, we try to transmit, but I think it's not coming on.
Can I try it again? Or would you like to transmit from your end? Is
Okay,
that fine?
and there's no problem. You could just control. I share the slide from my end.
Okay, that's fine. Then when I want you to go to the next, I will let you know.
No problem.
Apologies for wasting a minute or two in trying to share the screen. But a copy of this slide will be provided to us and much more after the session.
Kindly confirm that you can see the slides. Can you see the slides, Theophilus?
It's coming up here for me. Okay, no. I can see group of files that you are trying to share. I can see
Okay.
your folder.
Can you see this now?
Not yet. I can
Excuse me.
still see
Okay.
the folder
The
where the
folder
file.
itself.
Yes, I
Okay.
can see it.
Okay. Coming. Can you see the slide now?
Yes, I'm good now. Yes, thank you.
Okay. Can you see it now?
Sure, I'm good.
Okay.
I'm good now.
Okay.
So,
Sorry.
thank you. You can move to the next slide. That I'm speaking to financial state. Thank you so much. So, I was saying earlier that as an investor, as a student, curiosity can make you compare. For people to, in Nigeria, for instance, we have four major players in the telecommunication space. We have the MTN, we have the Airtel, we have Glo, and we have Etisalat. When people say MTN is the leader, the statement is not far from truth based on financial and non-financial parameters. You look at their customer base, you say they are the leader in that space. You look at their financials, look at the profit they are making, you say they are the leader. You look at the quality of their service, you say they are the leader. You look at their spread, how many states out of the 36 states in Nigeria have they covered? You look at a whole lot of things. You look at their assets, you look at their liability, you look at the quality of the information that is available in their financial, you say, oh, apparently this is the leader in this industry. That is the power of financial statement. However, accountants in their wisdom understands that people rely on financial statements to take decisions. So, in some instances, accountants can manipulate financials to give you the impression that you are looking for. But that is not the purpose of this class. But I will speak to it. That's why I said if you hold a financial, ordinarily there are guides to preparing financials. So accountants are supposed to maintain the professional ethics in preparing financials, but we will always find black sheep amongst us who circumvent those professional ethics for personal gain or to please their clients. Because when you prepare financial, it is expected that the chartered accountant stamp it, you put your seal on it, stating that you have verified it and is showing a true reflection of the financial position or the health of the organization. It's just like you going for a medical checkup. You've gotten a job, the organization has said go for a medical check to certify that you are fit for the job. And you confided in the doctor and say, please, I have high blood pressure, I have this issue or that issue, but I need this job so much. Please cover my ass. And the doctor say, oh, this is what you are paying. Okay, I can pay. And the doctor issue a medical report stating that you are fit for the job. That's just an analysis of what an accountant can do to manipulate figures to present something that when you put this analysis into play, you will say they are doing fine, while they may not necessarily be doing fine. So we will assume that the financial statement that we are going to be laying our hand on are statements that are showing true position of the organization. But I just want you to put your mind in that space too, that financials alone can also mislead, where the accountant who prepare or who sign has circumvented the expected professional ethic to preparing that statement. Now, when you pick up a financial statement, there's a link that I will drop a link right now in the chat box. That link will be for MRS financials. And the reason why I'm sharing that link with us is because I want us to see a typical financial statement and the kind of information that we can see therein. I just shared a link in the chat box, and that link is taking us to MRS Oil financial statement. In that financial, you will see a whole lot of things. You will see the chairman opening remark. You will see an overview of the business outlook for that year. If there are issues like what is pertinent to Nigeria, you will see things around FS, sourcing for financial. FS is talking about foreign exchange, if that is the challenge that is facing them. Talking about vandalization of some oil depot. They will talk about how a lot of things that affect their business, both positively and negatively. If you have clicked on that link, you will see on the content notice of annual general meeting. It is expected that in the annual general meeting, the members will come together and agree on the dividend that they want to pay, blah, blah, blah. So you see corporate information, leadership team, company profile, financial statement, chairman statement, and the rest of it. So that's what a typical financial statement looks like. But our focus in the financial statement is actually the figures. We, like I said earlier, that a financial statement is an handbook speaking or telling us a story of how the organization has performed in a particular year. It has to be a particular year, 2024, 2025, 2023, and we can still have group of years. You can have 5 year summary. That helps the analyst to look at the trend. Where most of the financial will give you more than 1 year. They will give you the previous year, they will give you the current year. So you can be able to see at a glance how they are performing. Is there a growth? By mere looking at it, even without comparing, without computing anything. So our focus on the financial is the statement of financial position, which is also called balance sheet. Statement of income and expense. Previously, it is called profit and loss statement. Another focus is statement of cash flow. Another one is statement of equity, and the last one is notes to the account. Notes to the account is like a guide. When you are reading this kind of Bible, there's this kind of Bible that they put notes beneath it. that note is telling you, it is going to amplify certain lines in the Bible that, oh, this one, note to the account will not affect everything. It will affect specific areas, but that note will give you details that may not be available on that. When you see a figure and you see a note behind it, so how that figure was to be, you will see in the makeup, maybe a special computation somewhere to tell you more about the note. If you are following, you can type 11 in the chat box. Let me be sure I'm not speaking to myself. You can type 11 in the chat box if you are following this conversation. Thank you, Ayotunde. Thank you, Tijani. Thank you, everyone. Thank you, Doreen. Thank you. I can see we are following. Uzen, can please go to the next slide. Having given us an overview of what a financial statement is and our focus on it, like I said, you have a copy of this slide and much more after. I would have said we should share it before, but it will be a distraction. So let us play along then, much after we will have a copy of it to ourselves. So there's this thing they call depreciation and its method. When I look at the slide, the focus area that Uzen shared with me, it is necessary that we talk about depreciation and its method. There are several methods of depreciation, but we have limited it to these four popular or major methods. Before we look at the method, what is depreciation? Depreciation, according to ACCA definition, is the systematic allocation of depreciable amount of an asset over its useful life. In other words, depreciation applies accrual accounting to the capitalized cost of non-current assets and matches the cost to the period that it relates. Let me put it in my own English. You bought a vehicle. Let's say you bought a vehicle for 5 million naira. You and I know that based on wear and tear, based on advancement in technology, based on a whole lot bad road, you will see that the value of that vehicle will diminish from year to year. So depreciation is trying to look at how this value diminish, and we are placing a value on what diminishes in a particular year. Take for instance, you've bought that vehicle for 5 million as I earlier mentioned, and you have done an estimation that you will get the best of this vehicle in 5 years. So you have assumed that this vehicle that you purchased for 5 million naira will serve you excellently for 5 years. If you choose to use a straight line method, which is also called equal installment method, with that method, you will divide the cost of that vehicle by the estimated lifespan. So if you have estimated 5 years, you will say 5 million divided by 5 years, and that gives you a million per year. So what you are going to charge into the books of the organization is 1 million depreciation per year for that space of 5 years. What is the impact of depreciation in the financials? Depreciation will reduce your profit because it is seen as an expense. So if you have made 10 million naira in gross profit and you charge depreciation of 1 million, the profit reduces to 9 million. That is how we can use depreciation. However, the earlier analysis that I have just used can be much more than that. In some instance, you can say that vehicle that you purchased for 5 million and you have estimated to use it for 5 years, at the end of 5 years, there is a possibility that you will get a value that they call scrap value. Accountants call it scrap value. If you use the vehicle very well, at the end of the fifth year, you can be lucky to sell the scrap for 500,000. In that situation, our depreciation computation will change. Remember the word in the definition, depreciable amount. When I was defining depreciation earlier, I say it is a systematic allocation of depreciable amount. So depreciable amount at all time will be the cost minus scrap value or realization value or sales value. Different textbooks use any of these three words. So if you have purchased a vehicle for 5 million naira and you estimate that the vehicle will serve you for 5 years, and your sales value of the scrap or scrap value or realizable value at the end of that period is 500,000, your depreciable amount will become 4.5 million because you are assured at the end of the fifth year of getting 500,000 by selling that scrap. So what you will depreciate is going to be cost minus scrap value over the lifespan of that. Put this into figure. I have a page much after that speaks to this so that it won't look abstract to us. I just spoke to straight line method. There's another method that is called reducing balance method. It's another depreciation method where the balance at the end of the year is going to form the basis for depreciating it in the next year. As the name implies, reducing balance method. We have a question that will address all this. Then we have unit of production method. This is typically for manufacturing sector. If you have a machine, let's say ice block making machine, or any machine that is being used to produce an item, unit of production method can be an ideal kind of depreciation method to apply. And the focus on this method is to look at the production, estimated production, and allocate depreciation based on those production methods. You will agree with me that a new machine will produce much more number of units in their earlier year than in the later year. So if you purchase a big machine for a factory, and if all things being equal, it is 40 hours per week, it is likely that machine give you the best when it is still new before you begin to do some repairs, some downtime as a result of one thing or the other. So it is possible in your estimation to factor a lot of production into year one, year two. As you're getting to year three, you may be reducing it because the machine is getting old. There will be time that it will break down, that you have to call vendor to check and replace some parts in it. So we will get to that unit of production method, but I'm just giving you an overview. And the last one is sum of the year digits. Some of the year digits is just like playing with figures. As the name implies, we look at the sum of the year. So if you say this asset will serve you for 3 years, you sum it together. Year one, year two, year three. If you say it's going to last you for 5 years, you will say 5, 4, 3, 2, 1. If you say 6 years, you sum 6 plus 5 plus 4 plus 3 plus 2 plus 1. Then the year one is going to be 6 over 21. Year two is going to be 5 over 21. Year three is going to be 4 over 21, like that till the end. And you apply it against the depreciable amount. Please go to the next slide. The next slide is talking about a question, a single question, where we can test this depreciation scale that I have discussed in the previous slide. And the question I will be reading to us, the background information. On January 2020, Amana Manufacturing Limited purchased a production machine with the following details. Please take note of the details that we'll be talking about here now. So the details is cost of the machine is 5 million naira. The estimated useful life is 5 years. The estimated residual or salvage value, I used the word salvage earlier when I was talking about straight line method. So this question is overloaded with a whole lot of information, but it is your responsibility to know where to use this information when it comes to depreciation computation, but it's not a difficult thing to do. So we are giving the cost of the machine, we are giving the estimated useful life, we are also giving the salvage value. That is how much the owner can realize at the end of that fifth year when he chooses to resell. And lastly, we are giving estimated total production output over its useful life. That this machine can produce up to 200,000 units over its useful life. And we are giving that 200,000 was broken down for us into year one, year two, year three, and year four. You will see year one, 40,000. If you add it together, it should agree to 200,000. It should agree. So you have the year one, we estimated that it will produce 40 units, 40,000 units, year two, 55. You will see that it's going to decline after year three. It's natural. Even if you buy your vehicle new, share leather, as Nigerian people will call it, after year one, year two, you begin to visit mechanic from time to time. You begin to complain, shortage in oil, tire, this, that. But you can get the best in the year one and year two. Oh, on the express, you are blazing, all good. So at year three, 50,000, year four, 30,000, and year five, 25,000. We are told to use for each of the please pick up those four information: cost of the machine, estimated useful life, salvage value, and the total production unit. That's all we need as we are going to the next slide. Please go to the next slide. Thank you. So the first one I said, we are going to use a straight line method. And I said before, that straight line method is also called equal, they call equal installment because
So,
when you apply
sorry,
this formula, okay,
sorry, Theophilus, sorry to take you back.
okay.
Isn't it? Since it's quite appreciable if the participants also open Excel so that they can also follow the explanation, so that way the calculations we can all move at the same pace and arrive at the same destination, so that way
All right.
there's an onboarding practical experience.
That means that you have assumed that we are all using our system to listen to this session. For some though who are on their phone, okay, phone should be able to use Excel if you can maneuver your way, but let me assume that majority of us are on laptop. So please open an Excel file because there are shortcuts that we can use to quickly
Or,
compute.
or, or is there a different way we can also do this calculation without necessarily using an Excel?
Excel is the fastest and more accurate too. Unlike when you're pressing your calculator, you may make mistake in punching, but in Excel, unless your input is wrong, your output will never be wrong. If you get your, so let's adopt the Excel. But I just want to call your attention to the fact that some may be joining on their phone, especially if they're at work or on the road.
Okay, or can we do it this way? Can we have you share your screen? That way, then you then work the Excel so that everyone, whether or not they have an Excel, they can see the calculations being done in real time.
Okay, let me speak to this first slide, and I will share an Excel to speak to it.
Thank
After
you.
this first one, I will do an Excel. Thank you so much. So
Thank you.
the first one we are using straight line method, and the formula for straight line method is cost minus scrap value divided by useful life. I will repeat that again. The cost of the machine minus scrap value divided by useful life. So the cost in that question was 50 million and the scrap was 5 million. So if you take 5 million from 50 million, you have 45 million left. And the useful life is 5 years. So if you see 45 million divided by 5, you get 9 million for each of the years. Year 1, 2, 3, 4, and 5. And that is what was presented in this page that you are seeing. You will see the opening book value, 50 million in year 1. However, when we apply our depreciation, you see depreciation for each year, 9 million across the years. That's the reason why it is called equal installments. And after this note, I'll go back to the Excel to put it to us. I will do our Excel. So I'm reading the note to that solution. The machine purchased on 1st January 2020, it cost 50 million. Salvage value 5 million. Useful life 5 years. So the depreciable base is cost minus salvage over useful life. That's straightforward. Um, for me to share my own Excel to be able to work it out, Jose may need to pause his own. Is that correct?
Yes, I think so. Or I
So,
think you might.
or if you are on Excel, I can give you, okay, maybe you can respond via chat. Are we all on the laptop? I can give you the prompt to be able to do it. If you're on the laptop, please press 0. If you're on your phone, press 1. If you're on laptop, 0. If you're on the phone, 1. Laptop, 0. On the phone, 1. If you're using your laptop, 0. Only one respondent. Oh, a lot of people are on their phone. only few people are on the laptop. So I will need to share my slide. Thank you, thank you. I will need to share my slide to demonstrate how we do this.
Okay,
So
so please,
I think I,
is it while Theo is going to share his slides, is going to share his screen in order to for me to follow with the Excel. I would move back to the example given so that while on the phone you can screenshot. That way you have the information within which to follow what is being done on Excel. I'm trying to as much as possible to ensure that it's as practicable as possible, and that way, whatever is taught here, you can go back home and implement. So please, I've gone back to the information given. If once you do screenshots, please confirm it's one. Can you press the number one? So I know that you've screenshotted it, please. Okay, if you have maybe three more, thank you. Okay, thank you. So I'm going to stop sharing so that Theophilus can then share his screen to have the Excel showing. Thank you.
thank you. So I believe we have done a screenshot of the question. So I will be sharing my Excel now and trying to show my formula. Can you see my Excel, please?
Not at the moment.
Okay, let me try to share. Um, okay, I think I'm able to share now. Can you see my Excel?
Okay, it's transmitting. Yes, yes, yes.
Okay, all these details are given in the question, so I do not manufacture them. We have 50 million as the cost, and we have 500, is it 5 million? 5 million as the scrap. Let me go back to the question and be sure. I think it's 5 million.
Yes, we have
It's 5
5 million
million.
as the scrap. Yes.
Good. So I'm saying year. So I'm saying year. So this would be year one, year two, year three, year four, year five. So we will say that the formula is cost minus scrap divided by useful life. So that's our formula for straight line method. So I will say this one, depreciation computation for straight line method. So this is our formula here, cost minus scrap over useful life. And whatever we get for 1 year is going to be the same for the second, third, and that's why it is called the straight line method or equal installment. That's what it is called. Now, in this place, I want to get the depreciation for year one. This is year one to five. So I said equals to, that's my command, equals to cost minus scrap divided by useful life. And I will say enter. No, sorry. This is 40 cost minus scrap, close bracket. Okay. Pardon me, it is the board mass that play out in that place. You can see that we got 49 earlier because the exec considered 550 million minus, okay, let me go back and do it again. I delete. I said the command is equal to my cost. My cost based on the exec, you'll see it on C5. My cost minus my scrap. I close the bracket. Sorry. So this is equals to bracket cost minus scrap close bracket divided by useful life. Enter key. For the 2 or 3 people that responded that they are on their system, you can try this. For the people who are following on their phone, I will do it again. I delete. Is equal to is always this first prompt we use to put our exam formula. So I said is equal to my cost is equal to open bracket my cost minus scrap close bracket divided to that's the sign I'm showing there divided by useful life. It gives me this. And because I said it is straight line method and also called equal installment, do you meant to get the year one right? Is the same thing for the entire 5. Either you can put it or not. It's going to be the same thing. So you can put your 9 million naira here, or you can as well repeat the same formula. It's going to be cost minus cost minus scrap close bracket divided by 5. The same thing you are going to get your 9 million. Then you can repeat it by saying 9 million, 9 million, 9 million. If you are sure that your first answer is correct, it is going to be 9 million across. That's the reason why they call it equal installment. Now, there's a way you can test yourself to be sure that you did not miss it. How do you test yourself? If you sum it together, what you should get should be 45. If you sum it together, this is summation sign on my Excel. If you look at my console, I moved up, summation sign, I got 45. 45 is correct. Why do I say it's correct? The amount that I can depreciate on this asset is 45 million because at the back of my mind, I know there is a scrap value of 5 million that I will realize at the end of year 5, which when I add back to this 45 million will give me the 50 million, which is the cost. Are we clear at this point on straight line method? I will go back to the chart to see our one. If you are clear, you can do 1-1 if you are clear. If you want me to explain again, there's no rush. The idea is for us to understand. So somebody say, how do we determine the scrap value? Sorry, I missed that, but somebody has responded to you. It was given in the question. That is very, very correct. So somebody said industry practice, regulatory guidelines, second hand market value of similar assets. Okay. For Ayotunde, I think you are speaking to a situation where you did not buy it new. You can also buy a used asset. We can still depreciate it. So if you buy a used asset, whatever you have paid at the point of purchase is going to stand as your cost. In your mind, you know it's not the cost because somebody already paid the cost ab initio when the person purchased it. So, but what you have paid for a second hand value becomes your own cost. Take, for instance, a vehicle could be selling for $20,000. Somebody bought that vehicle, used it for 10 years, and sells it to Nigeria market, Tokumbo, and you now purchase it for 10 million naira. For you, 10 million naira is your cost. Assume you may never know the initial cost, and you don't also need it for this purpose. You may never know. Even if you know, it has no relevance for the purpose of this depreciation. What you have paid is your cost for a second-hand asset. So I think I addressed Ayotunde's question. Now you can now estimate your scrap value that, okay, if you purchase a Tokumbo car, which is a second-hand car, you can say, I estimate that this car that I purchased 10 million will serve me for 4 more years. And at the end of the fourth year, I should be able to realize 2 million. Remember, it's an estimate. You may realize more than what you have estimated or less than. You will never be able to predict accurately, but be reasonable with your. It's just like you buying an iPhone. Nigerians are crazy with iPhone. So you may buy iPhone 16, for instance, for 2.5 million. And in your mind, oh, I will sell it after 3 years for 1.2. You may be lucky to sell it for that 1.2 or a price above that 1.2 or a price below that 1.2. But be reasonable when you are setting your scrap value. And that is another way when we get to window dressing. Another way for window dressing is manipulation. Window dressing is just a fashionable word that accounting use. We'll get there. There's a slide I put there, how we can use depreciation to maneuver our way to report much more profit than what the organization has made. You will see when we are done with this different depreciation method, you will see we will compare the outcome of each of the methods, and you will see how an accountant can use a depreciation method to manipulate figures to make the company look healthier than they are. So we will get there. But thank you, Ayotunde, for throwing this up. I said, can we get a 111 for one for if you are clear with straight line method, or if you want me to speak to anything, or if you have any question on it, because I will assume if I move on that we are all good on it. But if you have any area that you need me to speak to on straight line method, please share in the chat box so I can speak to it. If any area is not clear, because I will go to the next method, which is reducing balance method. But I don't want to leave you if you do not get anyone clear on straight line method. So according to Grace, she's fine. Do I have more people? It's very clear. Thank you so much. So we'll go to the next one. Now that you have the question with you, I will go back to the Excel. Okay, very clear. Thank you so much. I have three respondents on it. Azan, you may need to share the second one, which is reducing balance method. We will see the solution, and I will put us through on the Excel formula to go about it. Please transmit the page where we have reducing balance for solution. So
Okay.
as the name implies,
Let me. I'll see if it's possible for me and you to share at the same time.
oh, that would be
I'm coming.
interesting if
Wait.
it is doable.
I think so. I think so.
Will one not override the other?
No, I don't think so. Can you see the sharing of my screen?
Not yet.
How about now?
Not yet. If any other person can see, you can respond because network can be funny, but I've been good with network so far. But if any other person can see, please let us know via the chat. But I can't see at the moment.
Okay, I actually could see my screen.
Oh,
She
somebody can
just
see your
confirm.
screen. How come
Okay.
I'm not seeing? Okay, if she can
Wait.
see it, I'm okay. Since I have the slide on my system, I will just assume that we're on the same page, and I will speak to what I have on my system. So,
Okay.
if
So
you're on the
please,
the page where I want,
can someone confirm if okay? I think I've brought it back.
oh, I think I get
I've
my point. I need to stop sharing for me to be able to see you. I'm still sharing at my end, so that's why I couldn't see yours. So let me stop sharing. I will possibly see your own right now. So
okay.
for
So
me
I
to
think we can
for
alternate it.
Yes, that's fine. So I stop sharing now and I am able to see your own. So this is the last one I spoke to, that's straight line
Okay.
method. So the next one is reducing balance method. This 40% wasn't given in the question, so I assume. But an examiner will give you a rate. They call it, you know that I designed a question to address all the four methods. So examiner will give us a rate to apply in computing depreciation. So examiner will never leave us to assume because leaving each student to assume will amount to getting varied answer, which will cost him much time to mark. So he would rather give you a single rate so that when he's marking, he can have a single marking guide to all of you. So reducing balance method will also look like this. Year one depreciation is going to be the cost, the cost multiplied by that rate. Again, year one, we're calculating depreciation for 5 years. That's the useful life. It is going to be 40% multiplied by the cost, which is 20 million. That is what we are charging for year one. Now, because they call it reducing balance method, this is where the reducing comes into play. The 50 million that appear to be the cost in year one, at the end of year one, it has become 30 million. Because you charge depreciation of 20 million, the value of that asset will not be 50 million again at the beginning of year two. It will now be 30 million. So year two, we are applying 30 million because the asset has reduced from 50 million to 30 by applying 40% rate. That's the idea behind reducing balance method. Now we apply 40% on 30 million. That gives us 12 million. That 12 million is our depreciation for year two. And when we take that 12 million away from 30 million, we have a net book value of 18 million. So if anybody asks you, what is the value of this asset at the end of year two? Is 18 million. Because we have charged 20 million in year one and we have charged 12 million in year two. So our 18 million becomes the opening balance in year three. We apply 40% again, and that gives us 7.2. When we take the 7.2 away from 18 million, we have 10.8. 10.8 becomes our opening balance in year four. We apply 40% again, we got 4.320. When we take 4.320 from 10.8, we have 6.4. Our year five, we're starting with 6.4. We apply 40%, we got 2.5. This is where it is becoming a little tricky. Remember that we have a scrap value ab initio from the question that tells us that we are likely going to realize 5 million at the end of year one, when we at the end of year five when we sell the asset. So ordinarily, the depreciation for year five here should be 2.592, which is the 40% of 6,480,000. But that's not going to be our depreciation, because if we say that should be our depreciation, our book value is going to be 3.8 and our book value should be 5 million. Let me state it again. We are told from the question that we are able to realize 5 million at the end of year five. So that 5 million is like a guarantee that we are certain of getting it. So if we now say we are certain of getting 5 million at year five, then what we could charge as depreciation in year four, in year five rather, is going to be that 6 million that we open with less 5 million, less 5 million, and that will give us 1.480. I will repeat again in case it's not clear. Just like the question earlier given to us, 5 million is the scrap value that we are certain of realizing at the end of year five. I'm sure everything is clear until year five. I want to assume that everything is clear up to year five. So that year five, you open with 6,480,000, and you wanted to apply your 40% the way we have been applying. You realize that 40% on 6.480 gives us 2.592. 2.592 is not a bad figure, it's correct. However, because you have to consider the salvage value, you will not take this 2.592 as the correct depreciation for that year. You will first of all take your 5 million out of 6.480. Whatever you have left is your depreciation for year five. That is why that last note is stating that, so set year five depreciation is equal to opening book value, which is 6,480,000, minus salvage value, which is 1,480,000. That is your depreciation for year five. If you want to apply Excel to solving this, I will stop um, reading what Hussein is sharing while I will try to transmit Excel from my side here.
Okay, I will stop
Um,
sharing so that you can share your Excel. So once you've shared,
thank,
just let me know so that I can close mine.
I just did. I just shared my Excel. So what you are seeing on the screen is the last solution. So I'm going to edit it from straight line method. I will turn it to reducing.
No, why, Theophilus, why instead of editing it, why not just move
Okay,
to a different line and then have it?
okay, that's fine. So I pick
Thank you
it
very much.
and I come here to say this one is reducing balance method. Now, I said reducing balance method. My heading, I will say cost, scrap, and useful life. No, useful life, I will not need it here. So, cost, scrap, I will still bring it down. I will say cost scrap. I have it here, so I would say this is the okay. Let me say my rate. My rate is 40%. My rate is 40%. My cost here, the depreciation here, and the book value here. So my rate is 0.4. Remember I said we assume this. So then let me now say my depreciation for each year. So depreciation for, I will say, let me put year here. So year one, year two, year three, year four, year five. So my rate here and the cost here is going to be my 50 million, 50 million. Um, okay, so 50 million. Now my depreciation here is going to be equals to this cost multiply by rate, enter key. I go back there again, I delete, is equal to cost. I just click on that cell where the 50 million is. Then I do my shift 8 on your letter 8. My own letter 8 is where my multiplication sign is. So I say shift 8. So for those of you who are on computer, I say shift 8. Shift is to be able to use my next key up there on letter 8. So G8, which is where my cost is, multiplied by rate. I have 20 million. So my book value here is going to be is equal to cost minus depreciation I have there. So to formalize it, my next cost, I will just say for year two, my next cost is going to be the book value of the year. So I'll just say that this one is going to be here. So this one is going to be closing book here, and this one is got to. You see that on its own, my cost will come. It will populate. It's a matter of getting my book value. It will populate. So my rate is fixed, which is 0.4. 0.4 is the same thing as 40%. So you can as well bring this one down, copy and paste. Look at what I did. Because there's a formula in this 20 million. I said copy and paste, and I'm good. I can as well copy and paste, copy this 30 million, copy and paste. Because there's a formula here that is constant, you can see that the 18 million populate on its own. Now, this 12 million, copy and paste, you give me 7.2. If I say 18 million, copy and paste, what I've done in copy and paste is to say, system, reduce this 50 million by the depreciation of 20 million, and it gives me 30. System, reduce this 30 million by 12, it gives me 18. System, reduce 18 million by 7.2, it gives me 10.8. This next one, I said copy 7.2, paste. Give me this. Copy 10.8, paste. Now, what you have on the screen when Uzain was sharing is this 6,480,000. And we are giving 5 million here as our scrap value, which is now book value. At the end of year 5, 5 million is given to us. As such, our depreciation here is going to be difference between the 5 million and this, which I can now say is equal to this minus this. 1,480. If you are familiar with the figure that Uzain was sharing, I said earlier that instead of you to apply 40% on this, if I apply 40%, let me show you what it is. If I apply 40%, escape. If I apply 40%, I will have gotten 25992. And this balance here will have been 3,888,000. But this last balance must be 5 million. So I have to discard 3,888,000. I have to put 5 million there. And for me to put 5 million there, I need to manually get my depreciation for year 5, which is 6,480 minus 5 million. So I said is equal to 6,480 minus 5 million. I have this. So in essence, when they say reducing balance, what they are doing is that as the balance of the asset is reducing, our rate is constant. So we are applying the rate on the reduced balance. You remember the first one, I said straight line method or equal installment. And by definition and in practice, whatever you get for year one is what you get across the years for straight line method, which is also called equal installment. For reducing balance, you are applying that same rate given to us by the book balance. Your book balance in the year one is the cost. Your book balance in year two is the cost minus depreciation charge in year one. So your book balance in year two is the cost minus depreciation of year one and year two. I can demonstrate it here. So our year one, 50 million is the cost. Depreciation is 20 million. Our book value is 30 million. We carry our book value to become the cost in the year two, and we apply 40%, we got 12 million. Our book value now is the summation, is cost minus summation of the depreciation for 2 years. So you can say 50,000 minus 32. That is how we arrive at 18. 18 is our book value at the end of year two, which becomes our opening balance at the beginning of year three. We apply 40%, and our book value at the end of year three is 10.8. How do we arrive at this 10.8? 50 million minus summation of the three depreciation charge for year one, year two, year three. By my Excel here, depreciation charge for the 3 years is 39,200,000. Net it from 50 million, you get your book value. Let me go to the chat box in case a question is waiting for me so I can address that question and to know if we are following. The chat box, I need to check if there are questions or something in the chat box. Somebody said, is salvage the same thing as scrap value? Yes. There are three names that you can use. You can use salvage value, scrap value, residual value. I think I tried to do justice to that in the introduction. Some textbook will call it salvage value, some people will call it scrap value, some people will call it residual value. It is the value that you realize when you abandon it. So when you say you are tired of this iPhone, maybe the screen is damaged or the battery has reduced from 100% to 72%. Somebody will price it at, oh no, no, I cannot pay 1 million for this now. I look at the battery. Battery is now 72. Okay, what can you pay? The person says, I can only pay 400,000. That 400,000 is your residual value, is your scrap value, is your salvage value. So any of these three is speaking to the same thing. And if you think we have addressed reducing balance method and there's no question, if you are good with the residual balance, you can press 11 in the chat box. 11 if you are clear. If you want me to speak to a specific, speak to the chat box. I will be able to speak to that area. So I have 11 from two people. So I do not want to assume that others are clear. If it is not clear by others, tell me area you want me to speak to. I will do that. But for the people that say
Yeah.
11, I want to I appreciate you, but I assume that you are fine. That's why you put 11 there. So if you are not putting 11, tell me the area you want me to speak to. So I can quickly
No,
do that before we go to the next.
okay, Theophilus, I think because of time,
Yeah,
the earlier session, the earlier time we had allocated would have, covered the whole lot. But since,
yeah.
we have at least two people saying that, they are following, I think we can move on to the next. So whichever question that pops up, we can always dilly-dally back to ensure that,
Okay,
we clarify that area. So
okay, that's fine.
thankfully, we have three now. So yes, we can move.
Okay, so you can start sharing from your end for the next method, the position method. I will stop sharing from my end while I expect you to go to the next one is going to be unit of production method.
Yes. Yes.
Okay,
So I
so
have
we
that.
have we have done reducing balance. Please go to the next.
Bless you.
Okay, thank you.
But this is
For
the
unit
this
of
is the calculation. I gave the question earlier, so you can speak to the question. Oh, sorry.
yeah,
Oh,
no,
okay.
yes. For this one, in the question, we were given the total units that the machine will be able to work in the space of 5 years. Now, we need to know the rate. We are given 50 million as the cost of the machine. We are given 5 million as the scrap, and we are given 200,000 units. That the machine has the capacity to deliver that much in a space of 5 years. So what we have done is that we want to calculate what is the cost rate per unit. Rate per unit. So we say 45 million divided by 200,000 units. Then we got 225 naira per unit. Again, in the question, we were given the breakdown of that 200,000 units. That in year one, the machine will be able to produce 40,000 units. In year two, it will be able to produce 55,000 units. Year three, 50,000. Year four, 30, and year five, 25. So when you get the slide, you will be able to see this. So what we now do is that since we know the cost per unit or the rate per unit, let me use the right word, rate per unit. We know it's already to over units that the machine can produce. That's how we got our rate per unit. So we already established 225 as the rate per unit. To now charge our depreciation, we apply that rate to the number of units, straightforward. 40,000 multiplied by 225 gives us depreciation for year one. Year two, 55,000 units multiplied by 225 gives us the depreciation. Year three, 50,000 multiplied by 225. So 225 is our constant rate. Just apply it on the unit produced and you got your depreciation. The next column that you are seeing, we call it accumulated depreciation, which is adding the year one depreciation is 9,000. Year two, 9 million rather. Year two is 21 million. How do we get 21 million? 9 million in year one plus 12 million in year two. That's straightforward. Now the closing balance is 50 million, which is the cost, less 9 million, which is the depreciation that we charge for year one. You have book value, closing book value as 41 million. Year two, when you establish your depreciation of 12 million, 375, you add it to the 9 million that you have charged in the year one. You have total depreciation of 21 million, 375. Take it from 50 million, you have this book value of 28 million, 625. The same thing for this one is one of the easiest, so straight. So let us go to the next one. But like I said, it is simplified in such that we may not have so much question around this. So this one is talking about some of the year digits. And some of the year digits, as I was explaining earlier, we were given 5 years. So when we say sum of the years digit method, we have 5 years as the estimated year. So we sum it together, 5 plus 4 plus 3 plus 2 plus 1. We have 15. And we have an assumption that because the machine is new, we are going to get the best from it in the first or earlier year. So we apply 5, which is the highest in that sequence. If it is if you are given 6 years, it's going to be 6 plus 5 plus 4 plus 3 plus 2 plus 1. You will get 21. In that situation of 21, you're starting from year one is going to be 6 over 21. So in this case, it is 5 over 15 for year one. It is 4 over 15 for year two, 3 over 15 for year three, 2 over 15 for year four, and 1 over 15 for year five. Now, you have taken the cost and you have taken the scrap value from it to arrive at 45 million. Now, 1 over 3 is the same thing as 5 over 15. All we did there is to say 5 year 1, 5 year 3. So we now said 45 million multiplied by 1 over 3. Our depreciation for year 1 is 15 million. For the second one, 4 over 15 multiplied by 45 million. If you punch your calculator, you will get 12 million. 3 over 15 is as good as 1 over 5 multiplied by 45 million, we got 9 million. And so till the fifth year where we did 1 over 15 multiplied by 45 million to get 3 million. The interesting part is that the depreciation for each year across different methods. I would say we may want to go to the next slide for us to have at a glance how it can be compared. So the first column, we have straight line method where I put SL. The next one, we have declining or reducing balance method. And the next one we have production unit method. The next one is sum of the year digits. Look at it across board. That's why I say a quick comparison of depreciation results across the four methods computed. In year one, under straight line method, we have 9 million. 9 million, in fact, across year one to five, because that mean is equal installment or straight line method. So we have 9 million across board. So year one, when depreciation is saying 9 million for straight line method, it's saying 20 million for reducing balance method, and it's saying 9 million for unit of production, it's saying 15 million for some of the year digits. Now, this is where accountants can take advantage. The higher the depreciation, the lower the profit. The lower the depreciation, the higher the profit. That is how sometimes, if you want to, you can use depreciation method to manipulate, or what we call window dressing, because different methods will provide different results. So depending on what we want to achieve, if we want to pay lower tax to the government, we can use a depreciation method that will make our depreciation be expanded or bigger, and our profit look smaller, and we
Thank
cheat
you.
the tax. What?
Thank you. I was just about to draw your attention, when you spoke about the effect of the depreciation with respect to the profit margin, to also
Oh,
then
yes,
speak
sir.
as to the tax payable, because, tax
Yes,
is
sir.
on profit. So if you don't have
Yes, sir.
a sizable profit at a given year, the government can't tax it.
Of course. They can't tax your loss, they can only tax your profit. So depending on what accountant wants to achieve, if the owner of the business says, accountant, please, I don't want to pay tax, I'm tired of this tax, please help me make my profit look within this range. So that is financial engineering, financial manipulation. But like I said, we need to understand how financial statement works, and that is why we are talking about it. So that when you see it at a glance, some companies will be doing much more better than what they have projected. It is for you to be able to look at the glance and see what is not seen on the face of it, or what is seen, what is not there that should be there. That's one of the reasons why we are here. So you have seen year one, 9 million, 20 million, 9 million, 15 million. Different method producing different results. Year two, 9 million, 12 million, 12 million, 12 million. That looks within the range for the last three. You can see 9 million, 7 million, 11 million, 9 million. 9 million, 4 million, 6 million, 6 million, 9 million, 1 million, 5 million, 3 million. So you can see how different differentiation method can impact on. So depending on what they want to achieve, you want to produce lower profit to be able to gain the tax system, or you want to appear better. You made a profit of 5 million, but you know that if you reduce your depreciation, your profit will go up. So where you're supposed to charge 2 million, where you're supposed to charge 10 million, you charge 2 million. That 8 million naira difference in the depreciation is going to impact on your profit. So your profit will shoot up by that 8 million, and you look better than what it should be. So people even pretend, although there's no way you can pretend. You rather charge less than to omit, because if you omit, a smart person will look at your financial and ask, where is your depreciation? All these assets in your books. Does that mean that you don't charge depreciation? So you cannot say you won't charge depreciation. You can only charge less. So the ideal point is to charge less or charge more, depending on what the motive is, but you can't sit on the fence. Depreciation must appear on your financial. So in this little review that we have done, we have looked at depreciation, what it means. We have looked into four methods of depreciation and how we can use this method to achieve certain things, which is ethically, we should be transparent. Ethically, financials should show a true reflection of what the organization is into. However, it is just for our consciousness to know that beyond reporting the true and fair position, it can also be used to, especially if a company want to sell, look at Tesla now, or look at one of those multinational, they want to sell shares to the public. For them to make it look like the share is worth buying, their financial that they will produce to you is going to, it must be attractive. Okay, take for instance a lady that is seriously looking for a man relationship. You cannot afford to go out not being at your best. Even those who are at their best, not everybody calls them. So you don't know where you meet the Mr. Right. So you want to go around in your at least modest, attractive way, such that, oh, maybe you'll be lucky on that day to meet the person that will ask you out, ask for your number, and see where that relationship will take you to. The same thing. The owner of the business that want to sell shares, that want to go to the public, we never want to come with a financial that will not attract you. So those are the reason why manipulations happen to entice you and make you see reason why, oh, this place is a very good place to invest based on the financial that you have seen, not knowing that one or two may have been manipulated to attract you. Please go to the next one, Hussein, because of our time. So I will not stay long on this. It's something you can read and understand. We have been talking about it earlier, but it's just for us to see. So window dressing using depreciation, another method. So window dressing or manipulation of financial statement to make company look stronger, you can choose a longer useful life. What is the impact? An asset that should serve you for 5 years, you say it will serve you for 10 years. But in your mind, you know that after year five, if it is not a scrap, it's close to a scrap. But by the time you call it 10 years, what you have done is to reduce the computation that you'll have done on depreciation to make sure that you charge lower depreciation and report bigger profit. That is one way to reduce depreciation. Please, the next one. You can see annual depreciation becomes smaller. Okay, sorry. You can see how, please go back. So annual depreciation becomes smaller, expense decrease, profit increase artificially, assets appear more valuable than their reality. That's the effect. Higher profit, higher asset balance, stronger balance sheet, but misleading. Next one, please. Focus on the bold part. Choosing inappropriate depreciation method can also be used for window dressing. Using straight line method instead of using balance because the gap, that's generally acceptable accounting standard, says that you should pick a method that is most suitable. So because there is this subjective nature in it, people can say straight line is most suitable for me, but you know it's not the most suitable. But because you have the liberty, you can argue it and say that's the most suitable. You can begin to look at all the options available and pick a inappropriate depreciation method to achieve minimizing your expense to inflate any profit. You can go to the next. That's why I say 1/6, 2/6. Another one is manipulating residual value. You know that realistically you cannot get more than 2 million at the end of the asset lifespan, but you state that you can get 10 million. You bought an iPhone for 1 million and you are telling yourself that you can still sell it for 1 million after 4 years. How now? Between me and you, they are on 17 now. They will do 18, they will do 19, they will do 20. So what will make me pay 1 million for your own when I can as well get a newer version? But you are fooling yourself to say you can realize the cost after 4 years. No, now you know it. One is no longer new. Two, newer ones have come out. So you are setting an estimation that is fooling the system, gaming the system just for you to be able to reduce your depreciation base and have a lower expense. That's how depreciation can also be used to manipulate financial. Next one, please. This is going to be 4/6. That's deferring depreciation charge. Sometimes they call some deferring is allowed in accounting. You can say for the reason best known to you couldn't pass this entry right now. So you pass the entry much after financial has been released. You cannot put in the note that you need an expert to estimate this and this. As a result, you couldn't pass depreciation. You know your depreciation, but you are hiding on technical guide for you to defer the charge. So if you do not report depreciation at all, your profit will look as if it's bigger. Then the next year, when you are now passing that defer, next year is going to suffer for it. So accountant may delay recording depreciation until later period it is allowed. Like for instance, I want to know my estimated lifespan and I may not be able to do that. I may need the expertise of a professional in that field. And depending on what you are valuing, they may not be readily available in your environment. So, okay, you can say in the notes of the account, I've engaged a professional who is visiting the country much after to estimate this, and as such, I cannot provide a depreciation for this. It is a lie, just because you do not want to record a figure for depreciation to boost your profits. Another way to manipulate. Then 5/6, please. Next. So another one is revaluation manipulation. Devaluation happen and is common in our climate here in Nigeria based on inflation and the rest of it. You can purchase a vehicle 4 years ago for 5 million, and to your surprise, after 3 or 4 years that the price should be going down, the value should be going down, you can still sell it for 7 million. In those environments, inflation is the reason why devaluation makes the asset that should be reducing in value to be increasing in value. So how do I mean? An accountant can say this asset was purchased 10 million, we have used it for 3 years. Actually, the price should be 6 million or 5 million based on the depreciation that we have charged. However, the market value right now, if you want to sell, market valuation is as high as this. So they can put a value that is not realistic on so they will now put it on the financial statement, revaluation value. Normally, assets should be declining in value. The only asset that we are told in accounting that doesn't depreciate is land. Every other thing should and must be depreciated, except land. But in situations like I've just explained, where inflation happened, asset that should, and I can testify to that. I bought a vehicle for 2 million, Corolla, 2007. After using it for 3 years, I was still able to get 4.2 on my Corolla because it is Nigeria. Price has gone up. If I want to, even the 4.2 I sold it, I cannot even afford another car. Corolla today in Nigeria is selling for 8, 9, 10 million of that same year. But at the time I bought it, it was so cheap. Inflation has happened, price has gone up, and I was able to realize, but the time value of money or the real value of that money is not, like I said, let us leave that, but people can take advantage of revaluation manipulation to window dress using depreciation. Now, the last one is going to be 6/6, is where we are. So we can also switch depreciation policy. You can say we have been using straight line method for year one, year two. Because you want to achieve a purpose, you can switch to another depreciation method. You are earlier saying that I want to use reducing balance. After 2 years, you switch to some of the year digit or to another depreciation method just to achieve a purpose. It's another way that accountants can use depreciation to window dress. Other ways aside depreciation, we can use stock, we can use cash in bank, we can use a whole lot, but that is not the reason why we are here. We are here to focus on financial issue, but it's just interesting to know some of these things so that when you see financials, you do not put your 100% mind on it. So yes, it is expected to be showing the true reflection, but they may not show. Have it at the back of your mind. They may not show. So go to the next one, please. Let me be sure that we don't have things that I'm missing in the chat. Please, can we get it recorded? Okay, somebody has addressed that. I tried to go to the chat at intervals to see if there are conversations that I should address. Now, we're talking about
Having
ratios. You want to say something? Please, you can speak.
no, okay,
My
that's fine. No,
co-host.
I just wanted to draw attention that the questions are being answered in real time as they are being asked. So you can continue. So the ones that require your attention, I'll draw your attention to it.
Thank you so much. So now the next one is ratio for sound decision. Ratio in our elementary mathematics knowledge is putting two figures together and try to base them. One will be the denominator, one will be the what they call that language now for mathematician, denominator and numerator. So just like that in ratio, so we pick some figures in the financial and we are looking at their relationship. And we are using that ratio that we have completed to project if the company is LD or if they will remain LD. We are going to look at their current state and we're going to use that ratio to project that, okay, in the last 3, 4, 5 years, this ratio has been like this. Is there a likelihood of improvement? Will the situation be worsened off or will it be better based on these financials? Now, financial ratio are calculations that compares two or more figures picked from the financial statement to measure performance, financial health. Analyst, investor, manager, they use this ratio to understand how well a company can meet their debt obligation, generate profit, or use resources effectively. So this is where we'll play more. The financial that we earlier talked about, the Dangote and the MRS oil, this is where we'll lay our hands on and we will try to do justice to.
Okay,
You're calling
Theophilus,
me?
yes,
Yes.
please. I'm also mindful of the fact that you have an engagement and you need to leave at 3:50. So could you just, I know from the slides, we still have a bit of more broader explanation with respect to ratios, talking about liquidity ratios, looking at leverage ratios, looking at the limitations of them, and also, the efficiency itself. So can you just, in the slides, that this slide and the next slide that have reference to them, can we just give like a brief summary of them, since they can read the slides after being shared, so that we can then go into looking at the financial statements. That way, you are then able to marry practical, what's the name, activity with the theoretical knowledge.
Okay, that's fine. I will say that since we're going to have access to that slide, let me quickly jump to MRS. I earlier shared MRS. I think I shared their live report. So I will quickly come here, share it on the chat box, because it's going to be live, the data of MRS that is available on their website, that we're going to be exploring, and we will be on page 54, 55, and 50, 56, 57. So I opened on my system here the annual report of MRS for year 2024. So I just open it. I'll be going to that link that I showed you. It will give you their financial for a few years. I think the financial started on their website from 2016. So just scroll down, and when you scroll down, you scroll to 2024. That's what our focus is. So you can copy that link. That's the source of. So I just say 57, page 50, 54. So page 54, 56, 57. That's where my data, what I will be using is, and it will be fine for you either on your phone or your system to be able to follow through. So the link is already shared by Barista, my colleague Hussein, learned colleague, as you guys will call it. So MRS is what I have there. Then page 56 and 57 is where the balance sheet and income statement is, and we'll be able to test some of these ratios. If you are there, if you are able to on your phone or your system, please signal so that I won't be speaking to myself. I want to be sure you can signal. You can try type 0 if you are there. You've clicked that MRS, or you have been able to. Okay, somebody said 0. So when you click it, you go to the last part. You will see the financial that we're talking about is 2024. That's MRS Oil Nigeria PLC 2024 annual report updated final. That's the title of that report. If you have it, so it's only one person. Okay. I want to believe that people who are on phone, they should just play along, and the knowledge will be able to be. You'll be okay. Two persons. Okay. Okay. Play along what we are doing. Get the knowledge, and when you get home, you can open your phone, download that material or your system, and see how we play with it. Okay, let me do this. I think I can screenshot the thing for. I can screenshot on the page for people, so that people who are on their phone will not miss out totally, totally. So I have sorry, 1 minute. I want to do a screenshot so that what we are working on, people online can also. I don't want to lose my participant. So I just copied something that I'm going to paste in the chat box, and that should help in a little way. Oh God, I'm not sure this allow
Or
me to paste image.
or better still, Theophilus, I
Hmm?
can stop sharing. Since
Okay.
you have
Oh,
since you have
great,
that
great,
data,
great,
then
great.
I will just go in, try to either let you share, and then you can sort of lock your screen into two, so that
That will be fine.
we have the what's the
Oh,
name, the statement on one side, and
the
then we
slide.
have the Excel on one side. So that, yes. So
That's
if
fine.
I
That's
can
fine.
stop sharing now, and if that's fine by you, so you share.
That's fine. Please let me be available for it. Yes. So Are we able to see the
Yes.
MRS statement? Okay. Let me go up so you see that it's saying statement of profit or loss and other comprehensive income. That is this one, and it's ending for 2024 December. They have given us two financial year for the purpose of comparing. For your exam, you can have more than two, you can have three, four, or even five. There is no limit to what you can have. And the more data you have, the better for you. Because information that is available when it is, yes, there could be fear of overload of information. But when you have three, four, five, it's not too much for financial because a bad year doesn't mean that the four others will be bad. They may have overturned that bad year and you can see that in the so what I'm showing on my screen, you see their revenue in 2023, 182, in 2024, 312, almost doubled. Double will have been 364, but that's not where we're going. Cost of sales, just look at them. We will find a way. What we're looking for, I will show you when we get there. So this is statement of profit and loss. We have the gross profit, cost of sales. So how do we get gross profit? The revenue is also called sales. Sales minus cost of sales. So if your sales is 2 billion and the cost of selling it is 200 million, then your profit is 1.8 billion. That's just what you see here. Don't allow figure to frighten you. Figure is just figure. Forget about it. So when you have that bracket, what it's saying is that minus, so revenue is 312 in 2024. Then when they say cost of sales, the cost that the business has incurred to generate that revenue is 288. You can see that for oil and gas, a whole lot of expense exists in that space. You made a sales, a revenue of 312 million, and you have spent 888, leaving you with a profit of 23 million. Billion rather, because you see this 330, you see a naira sign and 30 up there. What it means is that whatever figure you are seeing here, you need to add 30 behind it. So this is in billion, even though it's showing in million, but it's in billion. But let us not allow that one confuse us. So this business had some other income, maybe they fix money in the bank, they have other income, administrative expense, and from that 23 billion profit, when they put their expense into it, they eventually ended up having 9 billion. The cost of sales is not expense. They are costs associated with sales. When you are talking of cost of sales, if you buy an iPhone for 1 million and you sell it for 1.5, the cost of sales is the cost of that iPhone that you bought, the logistics you spend in importing it. That's how you get your gross profit. Your other profit is you now say the sales girl that sits in your shop that you pay salary to, the rent in your shop, the light that you paid for. If you ever take that's those are the operating profit or operating expense, you see something like other income. Maybe in your shop, you allow another trader to share a part of your shop, so you get another income. You have a big store, you give somebody a space to use in your store, and the person is not taking that space for free. So you get another income. So those are the kind of other income. Then administrative expenses could be rent, could be lighting and the rest. Then you have selling and distributor. If you do adverts, go to social media, pay for ads, so that people can know you, blah blah blah. Then you have operating profit. If you had borrowed money from the bank to do business, you will always have finance costs. If you ever borrow money from bank or from any lender who do not give you zero tax, zero interest, you always have finance cost. There is finance income, there is finance cost. Finance income is what you get when bank give you interest on your deposit with them. That is a good one. If you have money in the bank and bank at the end of the month give you interest on it, finance income. But finance cost is the money you are paying as interest on the money you borrow from a lender, be it bank or anywhere. I'm just trying to analyze this profit and loss before we start to the pick figure after the other. So you come to your net profit, you take your tax element to arrive at profit after tax. And that is what is interplaying where we are. The next one is the statement of financial position, otherwise called balance sheet. In this balance sheet, it is summarized into asset, liability, equity. That is the Now, there's also current asset and current liability. Asset, in its real sense, are items of the organization that can last us beyond 12 months. Assets owned by an organization that they can be used for more than 12 months. And that is why you see plant and equipment under assets. You see rights of use under assets, intangible assets under non-current assets. The current assets, however, are assets that are expected to change the nature within 12 months. Like inventory. Another name for inventory is stock. Stock will come, go up, come down, go up, come down. So for inventory, the example of current asset, as you are selling, is going down. As you are restocking, is going up. So those are the kind of assets that within 12 months they change their nature and they call them current asset. Withholding tax, receivable, prepayment, blah blah blah, current asset. You get to a point where we say equity. You get to a point where we say liability. Liability can also be non-current, which is liability that you are not ready to pay them in 12 months space. But if it is current liability, they are liability that you are expected to offset within 12 months. You will see under current asset, trade and other receivable. These are sales that you have made without collecting money, but you are certain that in 30 days, in 40 days, in 60 days, they will pay you, and that will amount to the current year. The same thing applicable to current liability, liability that you will pay in the current financial year. But if it is non-current, there are obligations that you are not paying anytime soon over 1 year. So having said that, unfortunately, we couldn't go back to the slide. I've put formulas in the slide, but we will do justice. When you get it, it will be clearer. Under liquidity ratio, what do you want to achieve? You want to know how liquid the organization is. That is why some people will tell you that I am a rich man, but I'm not liquid right now. It's possible for you to say, yes, I'm rich. You have invested in Bitcoin, you have invested in this or that, but your account balance is 10 naira. You are rich. You have assets here and there, but cash, mba. So we are looking at how liquid the organization is. That is, in meeting, because you have current assets, you have current liability. How liquid are you in meeting your obligation as at when due? That is what liquidity ratio is measuring. And we have three key ratios under liquidity. We have current, let me go to the chart box. We have what we call current ratio. Current ratio, that's one. We have quick ratio, that's two. We have cash ratio, that's three. Now, current ratio, the formula is CA over CL. Current asset divided by current liability. That is current ratio for you. The quick ratio, in some textbook, they call it acidic ratio. It is CA minus stock. Another name for stock is inventory divided by CL. So quick ratio or acidic ratio is saying that all your current assets, take stock away from it. Why are we taking stock away from it? Stock, you have no idea when you can sell. You have no control over it. Or for your debtor, you can call them. Okay, somebody say, please show the slide to see the explanation. Okay, somebody want to see the slide. Please.
Yeah,
But we're trying to
yeah,
run against time, unfortunately.
yes, unfortunately, we are trying to run against time.
I wish I had
So,
time. Okay. Sorry, I don't know about your time. I'm available over the weekend. I can dedicate another 2 hours, but I don't know. I have another thing to do by 4. That's why I said I want to end this thing 5:30, not 3:50. I can dedicate time for Saturday or Sunday if you want. I'm not tired of, but I just want to end this 3:50.
yes,
I
okay,
don't know
we
what
would
you think
find a
of.
way.
If we agree on weekend,
So,
I don't mind.
if we the earlier time slot we had agreed would have allowed us go through the entire
My
spare of the
apologies,
thing,
please.
but
My
an
sincere
unexpected
apologies.
thing came up. So, but I think what we'll do is let us run the application on this statement, Then once the slide is shared, we can then have a proper understanding. But based on the survey, we also send the survey link. So in the survey link, if there is need for us to then bring him back probably over the weekend, we can also arrange that. So thank you. So apologies again.
Thank you, Okoye, and thank you everyone for your understanding. My sincere apologies. I've taken 40 minutes off the initial record, but not planned. This is a fraud week for my organization. I have another commitment. In fact, this is a working hour for me. In fact, but I'm not complaining. I'm just so sorry that we couldn't get to how far we plan to be. So, under the current ratio, as I've given the formula earlier, I will type it again. Current ratio, it is CA over CL. Now, I will go back to the page where I was displaying MRS. You will never see your CA and CL in the profit and loss. Never. It will be in the financial position. So, this is statement of profit and loss. I hope you are seeing my slide.
Yes, we can.
Okay, so now our CA is current asset. The good thing is that most examiners and financial statement will have computed it for you. The only thing I used to tell my people is that recompute, there may be a mistake, but most of the time I have not found a mistake once. So you will see a place where they wrote current asset, and there are 5 items under it: inventory, withholding tax receivable, prepayment, trade and other receivable, cash equivalent. So all these figures from 19, 18, 27, 17, 20, sum it together, you get 71, 71, 756, 870. That is for 2024. We will be doing for the 2 years. We will compute current ratio for 2024, and we also do the same for 2023. If it is 5 years that was given by the examiner, we will do the 3. So now, that is our current asset. Now, go down, you will see current liability. Current liability also have about 6 items: contract liability, dividend payable, trade, blah, blah, blah. So if you look at it, it's starting from 5.270. Next is 685. Next is 66 million dash D. And they have summed it together. You don't need to stress yourself. But exam purpose, you may have 3 hours, so you have a long time to press your calculator, but it's always sum together for you. So just pick 75 million 732,345. So we have the two figures already. Now I'm going to my Excel. We have 71 5 71 756 870 for current asset 2024, and we have 75 732 345 for current liability. If you're not clear, let me know. I won't rush. Current asset for 2024 is 71 756 870. Current liability for 2024 is 75 732 345. Now, for 2023, it's just beside it. 2023 current asset is 34 518 069. Current liability for 2023 is 31 473 781. Now I'm going to my Excel. On my Excel, what I'm trying to do there is to put a formula. Let me do sheet 1. So I'm saying, can you see? Let me be sure you are seeing my Excel.
No, you can just share the Excel.
Okay, let me transmit the Excel. Okay, I'm on the Excel now. You should be able to see my Excel. So I said, this is merge ratio computation for 2024 and 2023. Now, here I said current ratio, which is current ratio, which is CA over CL. Now, for 2020, 2024, and this is 2023. Now, I will just say the working now is equal to 756,870 over 75,732,345. It gives me 95%. When I round up, it is actually giving me 94.75. So let me use that exact word, 94.75. That is the ratio. That is the ratio of my current asset to my current liability. My current liability is higher than my current asset. My current asset can cover 95% of my current liability in 2024. Remember the figure I used, 2024. You will not see those figures again here unless you click here. Look at what I use. 71756. I can as well come here and put the figure if I want to. But I'm here. I want to do 2023. I put is equal to sign again. Then I go to the MRS. The MRS for 2023 is 34518,069 current asset. Then 314,73781 liability. I go back to my Excel now. So my Excel now. Can you see my Excel, please?
Yes, yes, we can see Excel.
Okay. So my current asset in 2023 is 34,518,069 divided by 31,473,781. I got this. What I got in 2023 is 1.096%. In this case, my current asset is slightly higher than my current liability. Now, when you have computed the ratio as we have it on the board, you don't leave it without a comment. There is a place here where you have to do your comment. You have to say that in 2023, the current asset of MRS is slightly higher than the current liability of MRS in that same period. However, moving into 2024, the current asset is slightly lower than the current liability in 2024, meaning that the 2023 financial based on liquidity is better than 2024. Let me repeat. When you have 1.96, remember that what we have on top is current asset and what we have below is current liability. So where we have 1.96, it's saying that our current asset is slightly higher, and in fact, it is so. 34 million against 31 million. 34 million, 34.5 is our current asset in 2023. Let me go back to the, so that I won't be speaking to let me share the MRS again. Can you see the MRS? No.
All right. I think we
Can
should
you
be able to
see?
see it now. Now that you stop sharing the Excel.
Okay. Now I'm showing it. So at a glance, remember that the 20 this is it. The what you have is 2024 before 2023. Now you can circle total current assets. In 2023, it is 34,518,069, which is slightly higher than 34,473,718. I hope you are seeing that my figure, where I'm calling it from. I'm
Yes.
comparing current asset against current liability. So you will see that when we got 1.096, it is given. Because if you sell the total current asset, if you realize them, they are able to offset your liability. However, when we move to 2024, their current liability is now higher, slightly above current asset. In fact, we are comparing 71,756,870 against 75,732,345. While the previous year was our current asset is slightly higher than current liability. In 2024, our current liability is slightly higher than current assets, meaning that the liquidity in the previous year is well managed than the current year. It is not always like this, oh. That's why we try to work on different financials. And again, we will likely take the last year question. Do you, by chance, still have the question for any of the sets so that we can touch your school question or what the lecturer have set before?
No, no. So I think because we have the time is already 3:50. So
Yeah.
can we, pending when the participants give us a response, we can
Feedback.
bring you back to complete this. But can you just speak as to the layman terms of the calculation we just did? What does it mean in 2023 vis-a-vis 2024? And then once you answer that, we then have a question that says, what are the things someone should note to know the good health of the company?
Thank you. The liquidity, as I said, is a ratio that is speaking to how healthy the organization is in terms of liquidity. An organization can be profitable and not liquid. An organization can have liquid and not profitable. And that is why the ratios are in different forms. And it is not good to use a ratio to form a conclusion. Ratios are used pari passu. You cannot use, we have liquidity ratio, we have leverage ratio, we have market value ratio. So you compute all the ratios and form an opinion based on it. You will not use one because one can be misleading. The fact that the liquid is not well managed doesn't mean that the company is not healthy. We will test other ratio for us to be able to say it's not okay here, it's not okay here, it's not okay here, then it's not okay. It could be that towards the end of the year, they got so much inventory. Maybe they have a signal that price will be going up next year, and the company now invest in inventory, making their current asset to go up, and maybe they are now owing current liability. You can see an instance. It doesn't entirely mean that they are now doing fine. And for the question that was asked, somebody said, okay, let me look at the question. Within a short, what are the things one should note? Okay, I just mentioned that. What you should note is how liquid they are, how profitable they are, the efficiency. There's a ratio that we compute for activity or efficiency and the market value. So if we put the combination of these ratios together, we will be, even if the preparer of the financials have manipulated in one area or the other, not everything will depend on depreciation. Not everything will depend on the stock. We'll be able to say, no matter the manipulation that may have happened, based on this, and this. So when we test our activity ratio, otherwise called efficiency ratio, it speaks to the profit in relation to the cost. So you have made this much sales, you have made this much profit. What have we invested to generate this profit? Somebody can invest 1 million and made 5 million. Somebody else can invest 1 million and make 500,000. If you are to invest in two companies, you will see that one has a higher ROI, but that is not the only basis. You will still check other things. So it is not a one-way drive to say if liquidity is fine, you sanction it to say it's a good place to invest. No. It's a combination of multiple ratios that will help us form a sound decision. That would be my response to Opeyemi.
Okay. I think Chukun also stated that his question, I believe it has been answered when he asked the question saying, can you switch methods within the period under review, either for window dressing purposes or other reason?
When you switch, it should be stated, the financial, they call it GAP, General Acceptable Financial Practice. State that in the note to the account, you must state that you change a policy or a method and why you did. But stating it is not a problem for an accountant. They will justify stating it. It's not like me coming late to work. I can say there is traffic. You can't do anything about traffic. I can say I had a slight headache. I need to see my doctor before coming. So stating it is just a requirement. I will find a reason that is comfortable for the reader of the message on why I have changed the method.
Okay. I think the important thing to note there is that whatever method that is being used is stated in the financials itself.
Financial.
Yeah, in the notes.
Thank you
Okay.
for your time. I really appreciate each and every listener and participant on the call. I wish to teach and to talk to people is my favorite thing to do. He knows me, but I just have to do something by 4 o'clock, and I can say
Yes.
I'm volunteering my weekend or any other time that is okay for you to continue from where we stop. It will be a
Thank you very
pleasure.
much. So, Obi, I'm so sorry that I can't bring you up to speak now because of the timing. But please, once we do send the survey, the feedback, you could then, once we have a higher pool requesting for this, we can always bring Theophilus back. So thank you very much for being with us from the beginning of the session to the end. And thank you so much for Mr. Theophilus for guiding us through how to examine the financial statements. It's a pity our time is constrained, but we're unable to go through the entire gamut of what we intended. But I believe with the slides and the recordings that will be shared, everyone can see what it is, the tools that are needed to ensure that once they see a financial statement, they can interpret it and make informed decisions for themselves and also on behalf of others or their clients. So thank you very much, everyone. Thank you very much, Mr. Theophilus. Thank you so much. Okay, bye,
You're
everyone.
welcome.
Thank you.
Thank you.